Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table. Welcome back. You are listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Folks, it is a pleasure to be here with you today. We're going to be diving into a part two for us, really a topic that's near and dear to all of us, and you included, whether you know it or not. Inflation is right there with you. Every day you go to the pump, every day you go to the grocery store, every day you're doing anything. Guess what? Inflation is with you. And so today we're going to be diving into more of our do's and don'ts with inflation and how to invest around inflation, because it is a big number today in comparison to where it's been in the past. My name is Seth Crossman, here once again with Dan Mickelin and Ben Brayshaw. How you guys doing today?
I'm doing good, Seth. Doing really good. How about you, Ben?
I'm doing good, Dan. I'm doing real good. I mean, inflation, not so good.
No.
But I'm excited for this second part to our show. This is we're going to finish up with some hardcore investment. We're really going to bring out all the guns on going through the 8 avenues that we think are strong investment opportunities in areas. We're going to talk a lot about the 4 or 5 big don'ts or to avoid areas. And I think that's really what's going to drive what people do next. We got a lot in front of us. We spent the last show talking, about the history of inflation, what we were expecting, the fears, the concerns, the woes, our hopes, kind of the overarching movements with the Fed. We're also, we talked about energy being the number one investment play among all the inflationary events in historical past as the best opportunity for investment. But we're gonna dive into a lot more of those and the particulars of those. We talked a lot about how energy on top of all of that is kind of in this perfect storm of separate from the demand of energy, but the push for the EV space and the amount of energy and oil specifically it's going to cost us in burning to create all that green accessibility energy, all those solar panels. And then we have this war, this Russian-Ukraine. I don't think, can we call it a war yet? I don't know. But, it ain't good, whatever it is. And then there's just a lot of stuff happening that's just pushing it. And Russia is one of the largest exporters of oil in the globe. And so, when we're facing the concern of sanctions and, the promise it might not be energy, well, how do you make people get to their knees? You hit it where it hurts worse, right? So that I think is just all kind of to mitigate all our fears. But, but there's just so many things going on with energy. And then, to see it inflate, it potentially poses a very, very, very strong opportunity right now as a possibility for hedging your inflationary concerns. So that's not the only place you should go. It's not the only place you can go. And if your risk area is not there, we've got plenty of places to talk about as opportunities to address inflation. And I'm excited about that.
Well, with that, it is time for Money in the News.
All right, first up, we got an article from Jean Sahidi out of CNN. Employers take note. Most remote workers don't want to go back to the office. And this seems like it's kind of been a ongoing theme as we try and pull out of this pandemic. But it's still amazing to me every time I see it, because I know in my house, everyone's just itching to get back out. I mean, it really it was an asylum there for a while. So the return to the office was very much welcomed. But what this article is saying is that 59% of America is still working at home, which is a decrease from 71% where it kind of tapped out, but it's still a massive increase over the pre-pandemic rate of 23%, which even that sounded to be relatively high. But the truth of it is that the majority, 61% of those who were working remotely, prefer to stay that way. And I think we've all seen in the news some major companies, particularly tech companies, kind of beginning to offer that option. I just don't know what that's going to say for long-term productivity here in the U.S. I mean, one thing that I've noticed, and this isn't coming out of the article or anything we've read, but just my own personal experience with customer service over the phone and online, it's just been absolutely terrible, and it just seems to be getting worse by the second. And a lot of that has to do with, I think, quite often, these people are working remotely, and it's not the kids in the background and the cat and the distraction of the television, all that, although I'm sure some of that plays into it. I just think it's the lack of ability for people to get together and complete a project.
I would agree. I kind of understand the tech world doing this remotely because they're always interacting in that fashion, even when they're in the office together,
right,
which I think is hilarious. But even my nephew he's moving. His tech company approved a work remotely for a year period for him. He's fine. He's been working remote. They don't have any plans on bringing him back, and he's doing well. They're hitting his numbers and projects, and I get that. The financial industry has completely kind of reversed from that, though. Like J.P. Morgan, Goldman Sachs. I mean, a lot of these bigger, financial companies have said, "Come back to work, or you're going to lose your job." In some cases, and I think that's interesting. But there's definitely camaraderie. I think there's the mental health side of this. I think is a big issue. Like people need to get out of their homes. I get the idea that your work home life is more balanced according to this article, but if you're home more, it should be. If it's not, you really got problems. Yeah, I think the downside about not being able to connect with your colleagues and that was highly cited. I get that.
One of the main things that I would factor in here is what's your commute, right? Because that can be a distraction or a nuisance to get to and from work, depending on where that's at. Also, what's the culture of of your workplace? You mentioned some of the tech places that the ones that I can think of off the top of my head. I wouldn't mind going there and hanging out, even though it's kind of almost a remote culture anyways. Play some ping pong, some bumper pool. They're just really fun places, I think, to go work and sit down on your beanbag with your laptop and get at it. Yeah, those are some things that I would take a look at as well. But also, like you're talking about, the fact that so many people are now in this remote work space and probably have said, where do I really want to live, or can I increase my quality of life living some other place and still working from there? That would be a design that would be hard to break.
I'm wondering, and from an investment perspective, and I've been thinking about this for a while, a lot of people don't want to go back to the office per se, but they don't want to be at home either. Because people have moved from where their houses were. They moved out of the city. They're not even regionally located necessarily anymore. But I'm just wondering about the Regus office spaces and in a different kind of rent something, but have some community because you're around people, but not being at home for the distraction of home. That's closer than the commute that we're talking about. I just wonder what the demand for those spaces will be, if any increase.
Yeah, and another investment take on this, which is one of the reasons that the article kind of caught my eye and then came to mind for the show, was you saw a lot of these work from home stocks, obviously skyrocket at the height of the pandemic. And as things have eased up and people have started to go back, a lot of them have really, taken a pretty big hit and tumbled pretty far. I'm thinking particularly of Zoom. But the reality is, I think that the climb was probably an overreaction, and so has the downhill motion of the stock price, because some of the things that we've adapted and just come to expect with the pandemic and this ability to work from home, depending upon what kind of career you have and specifically what you do, it's not going away. And these technologies are going to continue to be in play, and I think be viable companies, at a much grander scale than they were pre-pandemic.
But I do think we're going to see some companies really suffer from not having people in the workspace. I mean, there's definitely people who take advantage of this, and there's definitely people who thrive in it. And it's like, hey, if I don't have to do 2 hours of work. One company said they were hitting their numbers, not in this article, but I read somewhere else. One company their projects were getting done faster, expectations were higher. People were actually, because they were home, I don't know if they were just getting away from the kids because they were in the other room, went to their office and just worked, closed the door. Oh, daddy's got to work. So they were actually getting more time. I thought that was interesting. So
next up, we've got, as split rumors grow, investors say Tesla is being misanalyzed. This comes to us from Ivan Castano. This is from NASDAQ. What the article here is pointing towards is that there's potentially another split coming up for Tesla, which we just went through a share split last year. it'd be interesting to see them happen so close together. But one of the reasons why, and one of the kind of primary considerations for something like this, is when the stock price gets too high, there's kind of a marketing aspect to it, where if you split the stock, bring down the price, you invite more investors to participate.
Yeah, and I think that was one of Elon's goals. Was he said, the stock's too expensive; it shouldn't be priced there. Let's split it. I want more people to enjoy the stock, be part of the story. But it hit that $1,300 price, and boom, $1,373 before the pre-split, according to the article. And we've come really close to that $1,300 mark. We've bounced back down pretty heavily into the $800-900 range, but that being said, people are saying that the conversation around that still exists of, we need to make this affordable. But is it really affordable if you're overpaying for something, if theoretically, when it's the most expensive car company in the world?
Yeah, and I think that's the underlying current of the article here, is that regardless of what the price per share is, what's the company itself worth? Is it really the most valuable automaker on the planet 3 or 4 or 5 times over? That's what the stock price would tell you. But the reality of it is, in order to reach this valuation, based upon the research here of the author of the article, they'd have to be selling 31 million cars annually, which then coming nowhere even close to.
I've heard it said that, Tesla's not a car company. That's what people keep saying. It's not a car company. It's an idea company. It's a next thing company. Cars are one thing they do. And then the space travel and all of that stuff, I know, is all in conversation, and who knows what all this is going to become, because when you're super genius, whatever he is, I don't know.
He's boring tunnels underneath cities now. Obviously the guy's a genius and he builds a success, but it seems like he's on to the next pretty quickly these days.
Yeah, and so but if you turn something over to somebody else, he's made some very interesting plays. He stopped the manufacturing of like vans and kind of commercial vehicles to meet the car demand, which I thought was interesting. And he said, we can always get there. That's not the problem. They could meet more of a car demand by pushing that aside. And that's definitely an investor, business owner play. I thought that was pretty good.
Well, OPEC, what do you have for us today? OPEC rejects calls to increase production again, as Arab oil producers say group should stick to agreement. David Aro, Fox Business, bringing us this as U.S. crude prices reach highest levels since 2014. A timely article, something that I think is going to dovetail and work nicely into our investing topic today. Investing during and through inflation is what we're going to be talking about here soon. But this is always one of those things out there, especially with like the whole Putin thing going on, and as well, which that's a massive oil centric economy. The ministers of Arab oil producing countries gathered in Saudi Arabia Sunday, refusing basically pressure for OPEC to increase production again amid coronavirus pandemic recovery efforts as the potential war looms in Europe. So what does that mean? That means that basically they're not going to start pushing more oil into the economy to lower the prices of oil per barrel, as well as, what you're going to see reflected in inflation at the tank.
Basically, they were asking OPEC, do they want to increase their already projected increases? So they're already scheduled to make all these different increases at different increments that they all agreed to. One of the things I didn't want to talk about in the opening portion of the show is, and OPEC's not willing to really work with us anymore the way we want them to. The increases are there, and hopefully everything comes around. But for us to build more affordable everything, we need OPEC to really open up the valves, and we need Russia not to be, struggling here. And we need a pipeline from Canada. Like, we need a lot of oil in this country to do what we're going to do, and that's another issue. Putting all of that aside, the price per barrel of oil is really, really important, and a lot of people don't understand that. But when we cross that, depending on where you're located in the U.S., that's $65 to $85 a barrel oil, we start making shale oil affordable to harvest in the United States, and that's pretty heavily found in Colorado. And that's the oil that's kind of in the shale stone, and it's much more expensive. It's not a big jar in the ground that you can put a straw in and suck it dry. It's literally in the shale, and they have to get it out of the shale, and it's a much more complicated process and much more expensive. So there is some opportunity inside domestic production in the shale space, which I think is interesting, and obviously will be a call for more jobs in that space. So an interesting thing to think about.
Folks, that's going to do it for us in Money in the News. You're listening to Money on Tap. Today, we get to jump into do's and don'ts of investing during the inflationary period. That's what we're in, and that's what we're talking about today at Money on Tap. Don't go anywhere. We'll be right back. Do you have an annuity? Do you understand exactly how it works and when to use it? The likelihood is that you don't, or maybe you bought it a while ago because at the time it sounded like a good idea. But will it accomplish your goals? We are here to help you. Contact us about a free annuity review and learn what your annuity does and how it can best help you in your retirement goals. It's absolutely free to you. And if there's a better way for you to accomplish your goals, this is a great way for you to learn about those opportunities too. Take the time to get educated, get empowered, make your retirement a success. Call us at 855-226-8551 or info@yourmoneyontap.com.
Now back to Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Folks, we are talking about inflation and investing through inflationary periods. It's so critical if you're requiring income and your income is that's it. That's all you have for retirement from now until whenever, and you're trying to make sure that those dollars are going to make it all the way through and that your buying power is going to be increasing and staying ahead of this inflation. It is so critical to make sure that you are investing through these periods in a way that is going to allow you to continue to stay retired and retired successfully. Income, we talk about it. That's what we talk about on this show all the time. We talk about how do you create income? How do you keep income? How do you increase income so that you can retire successfully? Folks, if that's you, if you're in retirement and you have questions about how to do this, or what are some different techniques or different ways that you haven't even looked at or considered, you need to give us a call. And we'd love to sit down with you and spend time working through the topic that we have today, as well as what are some of the other concerns that you might have as an investor in and through your retirement. You can reach us at 855-226-8551 or info@yourmoneyontap.com. But so much to cover today. And a lot of it's really just the fascinating kind of really the underworkings in our economy and our investing to get to.
Yeah. We chatted last week heavily about, kind of some of the history of inflation. We talked to like what's going on with the Fed, the idea of raising rates by 0.5 point. Maybe they do a quarter. Hopefully that's what we hear next month. Because it's just really, I think we all have an agreed upon scenario that, the Fed's basically powerless in some of these moving pieces. I mean, Dan, you made the point that, the inflation alone was half of it was geared just because of the price of oil and new and used car prices. I mean, that's crazy. And I think everyone knows that car prices are out of control. And I don't know how much that's going to change over the next year, honestly. It's going to take time for, the market to fill up. I was talking to one guy at this Acura dealership. He told me that there was a number of cars that were sitting on the Acura lot that were completely finished being manufactured, but they couldn't get them shipped because they didn't have the tag for the type of car it was on the back, the emblem logo. So it's just interesting. They were just waiting for that to happen. And I mean, it's just very interesting, all the different dynamics that are happening. I don't think we know necessarily where the next one is, but we do know some generalities of that are strengths to invest. And we have our own opinions here today. We have a number of articles that we've, have as kind of like some interesting seeded information in the background too, as well, which I think is unique. And, I think the obviously we talked about the first number one item is is oil, energy. It is definitely the top performer anywhere. I mean, honestly, I was looking at this Wells Fargo article, and just to quote them, because it's well, we keep talking about it, but they're right off the bat. It goes, if you want to know what to own during inflation, know one word: oil. I just thought that was okay. And it goes, it's no AMC Entertainment stock. So that was an interesting article here that I read from Matt Krantz. Energy. We need it in every facet of our life. It is the core of everything we do. It is a major area. Investing in oil, there's lots of different ways you can do it. You can own oil stocks. We could be as basic as owning Chevron and Exxon and BP, and we're not recommending any particular company here, but it could be as that simplistic as that, or you could just get into an energy ETF, XLE. I mean, there's all sorts of spider ETFs on energy. There's energy pipelines. There's lots of ways to get exposure into energy. And so if you think one area of energy, if this is an area that you want to go into, is over purchase, meaning that the price is really, really high, there might be an area of energy that you can get some exposure to that maybe hasn't been, fully taken over by, the people moving with inflation, because we're not the only people that know this. And if you're just getting into this conversation, and if you've been listening to us or you go back to some of our historical tapes for the last 2 years, we have been extremely heavy energy. Very, very heavy energy on a higher note than normal, probably, and it's boded well for us. But it's honestly continues to appear to have legs moving forward.
Yeah, when you talk about energy and kind of how long we've been in energy, there's an expression that we use as long, right? Long or short is one of those investing terms, and that's where we're talking about. We have been in this. And we're continuing to stay in this because if you haven't paid attention to the conversation that we've had so far about how much energy is so critical for even creating those green energy pieces all around us and everything else, everything revolves around the sun, right? That's energy, folks. We're going to need this thing out here to continue to work with us if we want to continue to just stay afloat and working in every area of our life. So that's why I think one of the main reasons that we are long energy, and it's one of the places that when talking about it being in an inflationary period where the Fed is raising rates at 0.5% instead of 1/4 to try to, use that lever that they have out there to hedge or kind of combat this inflationary period. This is one of the places where it's just a no-brainer, and that's not necessarily, we're not here to tell you got to go do this. This is the recommendation or anything like that. We're just saying, hey, this is historically where in inflationary periods you take a look at that. I don't know. Let's go back to the since 2000. How have some of these asset classes performed? Well, this is one that has done remarkably well, and the data's out there. You can find it yourself, or come on in. We'd love to have a talk with you about what your setup is and how this is appropriate or inappropriate for you. And that's where the conversation needs to eventually land. We're going to take a look at several other sectors as well. Going into it, Dan, what do you have?
So another kind of play to potentially make when inflation gets bad is one that's is a place that people flee to whenever there's turbulence in the global markets, and that's gold. Right? It's time tested. It's been a valuable asset for as long as anybody's valued assets. So it makes sense that this would be a consideration. At other points in time, it's been very high, but quite honestly, gold by comparison is kind of at a lower point than where it's been during a lot of other difficult stretches in our economy and in the markets in general. So in considering that, it's certainly a place to take a look at, particularly if, war breaks out and some of the other kind of doom and gloom, bad news scenarios that are unfortunately kind of percolating out there. The more of that stuff that starts taking place globally, the better gold looks.
Yeah, I think, when you start talking about some of the currency plays, Yeah, currency gets really scary in a lot of different levels, and gold is definitely an alternative currency standard. But there's some of these electronic currencies that we talk about. They're alternatives. It might not be a play on gold. It might be a play on silver or platinum. There's lots of different hard metals that retain real value for all sorts of reasons, whether it's technology and manufacturing and so forth. That in a time of inflation, those things grow very rapidly. And
yeah, some of these precious metals are more valuable in an industrial sense than what gold is. You speak to that with silver and things like that are components in some of the technology that we have ongoing out there. So, maybe that's a consideration. And really, it kind of leads us into the next point is commodities, right? Mm-hmm. So that's another place that people turn to in high inflation periods. Because when you think about it, commodities, considered with energy and consumer staples and some of the topics that we've hit on already in the list here, you just try and think about those things that people have to have and people and companies have to buy regardless of the price.
Yeah, a commodity is just that. It's something you need. And, there's been a lot of conversation around consumer staples and stuff like that. And I would say that would probably be lower on my list right now than the straight up commodity market space. And I think that's interesting. I was looking at this that article I was referencing earlier from Wells Fargo. It was interesting. They were looking at the last 20 years about the inflationary periods and so forth, and oil's inflationary return was like 41%, and it was the highest. Where the USO ETF on the ETF space was like 65.2%. And then I really thought it was interesting when it started getting to things like gold, because I was, in trying to give people a comparison of like how much disparity there is. Oil at 41% as an inflationary return, gold was only 16%. That's a pretty big difference. And I think, when you're looking at like the USO ETF, it was up 65.2% in a 1 year percent change. The Spider Gold Trust was down 0.5% in that 1 year. It's just an interesting perspective, because I've actually listened to a lot of stuff, guys, on the shows, like the CNBCs and the Fox Business and so forth, debating between electric currency and, gold and all these different things as inflationary hedges. And I just don't think they carry the same weight. And I agree. And that's really what's coming out of a lot of these shows personally, that I tend to kind of agree with more and more. I don't know if you guys have any opinions on that.
Well, for one, I have the experience with gold. It is that place, that flight to safety, that tried and true kind of an asset out there that no matter it seems like who it is that we're sitting down with, they always have some friend that has been telling them, and they have the question as we're going through the planning process, hey, should I buy gold? Or, my friend says that that's all they buy is gold. And it's always kind of an interesting conversation to have, regardless of whatever the circumstances are in terms of an asset class and the commodities as well. The things that I think people need to have in perspective around these are that even if you're buying it in some kind of an ETF or whatever form or version you're buying it in, it's highly volatile. Just like anything else out there, you really have a lot of moving pieces, and you need to be aware of how this works inside of, and at what percentage of your allocation you're putting this into your portfolio.
I think if you're afraid, which is what gold is, it's a fear-based purchase, in my opinion. I think if you're dealing with that, and you're really not hedging inflation that way, I think the actual physical asset is worth 10 times what the actual purchase in the ETF. Sure. And so I just think it has more. If you're really concerned the world's going to, the end, and you don't want to own stocks, bonds, mutual, whatever it is that you're going to purchase, you're going gold, just go buy it somewhere. That's at that point in time, you don't really have much faith in a full recovery. So it's interesting, but, and we do invest in it from time to time, and it's usually short stints, and it has its place, but, and more in a cyclical pattern than anything else. So I think you make a great point, Dan, about it being lower. Another area that is really good for inflation is real estate. Real estate, I think, carries a lot of opportunity in a lot of different ways. Because real estate itself, the asset does grow with an inflationary component, right? It's growing in its value. But also if you own rental real estate, those rent rolls continue to grow. I've been hearing a lot of conversation on the news about how, rents are just so ridiculously high in some cities that, people can't even barely afford to pay the the rents. So therefore they can't even save for a house.
Yeah, there's a number of cities that I've seen that are up 20% year over year on rental rates, which, if you're in that market, if you're kind of an hourly wage earner and you're dealing with inflation and a 20% rent increase, I mean, that's some dire straits. I mean, that's where really people do get squeezed in these type of situations. So if you're at the end of the market where you're looking for rental opportunities, then that's a tough spot to be in. Whereas on the other side of that, as an investor, if you're looking for places to put cash and you have the opportunity to get invested in rental producing real estate, well, that's a kind of an ideal situation in times like this.
Yeah, there's only so much of it, right? One of the places I know that's been really hard hit in this capacity has been the Hawaiian Islands. There's just been, with the pandemic and everything that's happened through there, so much of the economy there is tied to service work, and that's the bulk of what happens in that scenario. There's been a lot of this tech advancement, a lot of people from, now working remotely being able to come in there and just buy up the real estate that they just don't have the real estate for renters, even in the service industries that are there to, give them a place to live. And so when you think about the supply demand scenarios, that's one of those places where real estate can be a very strong asset to consider. And there's different sectors of the real estate market as well. So pay attention to how it is that you're investing in real estate, either directly as a landlord, or are you buying it on the open market in some other form or fashion?
That's a really interesting point. And, probably before we take a break here, I was talking to a client actually today, and I was just making the reference. They were, and it's a pretty common theme, right? I'm going to pay off my house before I retire. And, that whole aspect of like, I just want to get that done. I don't want to have that bill hanging over my head. And I made the point to them that, they're paying that money off. They're paying that property off. And that does sound great. I mean, that really is a good goal to have. And that property is inflating, but the payment's not. The payment doesn't inflate when you pay on your house, right? And I was explaining to her that you have she's got a good 8-10 years to run before retirement. And I just said to her, I said, well, why aren't you just, instead of overpaying your mortgage to try to pay it off in 7 years, why not invest that as the stocks become more of a struggle, right? If the market's going to pull back, and that's what everyone's afraid of with this inflation and all the different fears there. And I don't necessarily agree with all that thinking, but if that's what the thinking, why not buy into one of the next pieces, which is we were going to talk about, high yield, dividend producing blue chip stocks that you can get an accomplished yield from that you feel good about. Let those stocks inflate with the inflation. And then at any point in time, you can pull that asset out plus the dividends you made and put that down towards the house. Because your payment is not inflating. That payment is not changing. The interest rate on that is not going up. I mean, assuming she had a fixed mortgage. And if that's the case, I mean, it's like I said, hey, listen, you're going to pay off this property, and yeah, it's going to have inflated, and that's wonderful, but you're not selling the property. So to achieve the benefit of the inflation on your dollars is still being lost. I don't know if that makes general sense to the listening public here, but that is an issue that people don't really quantify, is that, hey, my house is worth $200,000 or $300,000 more than it ever thought it would be worth. But if you can't get the money out, that's no good. And people say, well, I could loan it out. Well, then don't pay off the mortgage early, right? So, invest it in something really as secure as you can get that you feel comfortable with. Allow that to ride for that period of time. Continue making your regular mortgage payment. And at any point in time, you theoretically could have way more money than you ever projected, pay the house off when you hit retirement, and have potentially cash left over if all works well. Now, there's a lot of pitfalls in between. There's a lot of questions on what you're going to invest in and all of those different pieces. But the conversation about a non-inflationary payment against an inflationary asset and a non-inflationary investment, a little complicated, but something to think about if you're that listener.
Folks, there's lots to think about in this conversation, and we're going to give you a moment to just take a breather. Think about it. We're talking about investing in and through the inflationary periods. That's what we're in right now. And we've been talking a lot about these kind of what we call risk on, right? The commodities, gold, stocks, all that stuff, oil and gas. This is kind of a risk on approach. We are going to be talking about some of those more risk off approaches down the line here, where some of those cash plus assets can go get domiciled if you're not really feeling it. There's a lot to talk about here. You're listening to Money on Tap, and we'll be right back.
For a number of our listeners, they have a lot of questions, and you might be one of them. Today, we're just offering what we call Zoominars, webinars over Zoom meeting rooms, where we have top experts, Social Security, estate planning, and financial planning experts for you to speak with, do a private consultation that way today. We're also having webinar-based Zoominars where we're going to have multiple groups where you can be part of that and enjoy that as well. Give us a call at 855-226-8551 or email us at info@yourmoneyontap.com to schedule your Zoominar.
Now back to Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are talking about investing in and through inflationary periods. That pesky inflation working against your hard-earned dollar or your income current or in retirement. And it's a headwind that we battle, all of us. And what can you do about it? How can you invest to stay ahead of that? Gosh, there's a lot of great information that we enjoy covering during this. And we were talking a little bit about the real estate world. Maybe you're not the kind of person that is a direct participation going out there, buying rentals and being a landlord, or, buying real estate in other forms that, there's lots of it out there. There's lots of opportunities in that real estate world, but maybe you're just needing something that's a little bit more simple and hands off. Dan, would you like to talk to us a little bit about what that might look like?
Yeah, there's a couple of different opportunities out there, but specifically something that you don't need to worry about closing on and raising a down payment and going through all the process that's involved in acquiring traditional real estate, and that's simply a publicly traded REIT. Right, so there are these tools that perform like a stock, look like a stock, but they're real estate investment trusts is what they are. So it's a bundle of real estate classified in a number of different ways, so you can kind of slice and dice it to your particular interest. Particularly we just talked about residential rentals, right? So you can buy a REIT that's focused specifically on that market, that's professionally managed. The properties are already purchased, and in a lot of cases, particularly now, probably have close to 100% capacity in terms of renters in there, and they will fluctuate like a stock, and in the meantime, they'll produce a dividend for you. So it's a way that you can invest in a way that's going to not necessarily be correlated with the stock market, right? So when the stock market's going up or down, or you have fears about a downward trend, REITs perform differently. They don't go up when the stock market does necessarily. They kind of run on their own track, and all the time that you're owning it, in addition to the appreciation you hope to capture on the share price, you will begin to receive income off of it as well. So all those rents that are being collected over the thousands of units that are contained within the REIT, a piece of that gets broken off and paid to the investors at a certain interval, for all of those different units within. So it's an easy way to immediately get participation in the real estate world without having to go through the process of actually purchasing property.
Yeah, I think the REITs are probably, these traded REIT programs are, and it's not just, you made a great illustration of kind of rental property, like, apartments and so forth, but they've got storage programs and, multifamily complexes, and it's not like, it could be medical office buildings. It could be anything. There's all sorts of different types of exposures to classes.
You could be any kind of landlord you want pretty much instantly,
Yeah, and you don't have to worry about the phone call from the tenant. A lot of people say, "Hey, I'd love to be the real estate guy, but I can't fix things. I can't manage property. I can't I know nothing about plumbing or electrical or who to call, and I don't know what's a good piece of real estate to buy." Well, you can work with people like us or another financial professional and try to find yourself some real estate exposure, because I think that's really what, it's all about. It's just getting exposure to those different types of, asset classes that maybe you haven't. But real estate is phenomenal in inflationary environments, specifically because most of these programs have an inflationary component attached to their notes. They're either renting to somebody who's getting an annual increase based on whatever floating rate with LIBOR or whatever, background interest rate variable that they're using. They're usually not set in their ways. But at the same time, a lot of real estate programs, they're not like usually fixed 30-year notes either, though. Their business terms are usually 5 or 10-year fixed, and so they have a little bit of a variable to offset some of that and still actually make more money in time periods of inflation, which is really great. Because, hey, listen, if your rate's locked in for 4 or 5 years, maybe 8, 9 years, you hop into that, and all of a sudden they're raising rates on their tenants over the course of a few years, hey, you're making even more money. So,
yeah. So another place that is kind of somewhat feels like at times the REIT world is a leveraged loan world, right? And these are they're almost it's really hard to describe, really, because we're talking about something that will look like a REIT, kind of almost act like a REIT, whether it has that dividend coming off of it, but it's based off of loans going to companies that are collateralized. And a lot of the companies that are operating today, they have debt. It's part of the system that is used to create income for them and buy assets and work through their cash flows. And what a leveraged loan will do is kind of attach itself to these companies and organizations, and it's lent at a specific rate based off of what the Fed funds rate, the prime rate is, and all of these rates out there. But as the rates rise, these leveraged loans will usually create escalations inside of those loans as well. So it's a very raising rate environment, kind of a savvy instrument to be in when the rates are going higher. As well as these are collateralized, and most, depending on which level or tier or mezzanine of loan that you have with one of these vehicles, you could be actually at a favorable position if there were to be a liquidity event or some kind of a bankruptcy situation with these companies that they're lending against.
Yeah, I think, Seth, this is a very complex area, but I think the best way I would probably describe some of this for people, because this is super complex, is that sometimes you can own the real estate behind the real estate investment trust, and you're an owner in that you have an asset inside real estate, proportionately to your share value. But on the other side, these collateralized loan programs and so forth, some of those are the loans that people go to borrow to buy the real estate for the real estate investment trust. They're actually connected in some form or fashion. Sometimes they're loans right to corporations to do whatever they need to do, whether it's an expansion in a technology division or whatever. And sometimes it's senior secured, meaning it's the first round. Like if they go under or whatever, it's the first debt to be paid. That's senior secured. And that mezzanine space, usually you're the second or third, or you're somewhere after the senior secured space of getting paid. But they are floating rate, which is great because it brings you into the conversation that we have, which is the next one is floating rate loans. So I think probably the point I would want to jump into is the don'ts right now. So we've been talking about a lot of do's. We want to talk about a lot of don'ts. The don'ts, we kind of all know that, cash is a don't in this kind of world of inflation. Like cash is only going backwards. I mean, you were 7.8% going backwards. Boom, boom, every day you're walking backwards. And there's ways to make that percentage less, and we can talk about some of those in a minute. But the number 2 item is bonds. Now, bonds are really, really bad in an inflationary environment unless the world's going under, okay? In an inflationary environment, and the best illustration we can make, or I can make, is if you own a bond, and it's you pay $1,000 into the bond, which means you're lending money to a company, just like these floating rate loans. You pay $1,000 out, and you're going to get an interest rate back, and it might be, let's say it's 0.5%. It's a big blue chip company, Pfizer, I don't know, whoever. They're paying you 0.5% a year on that loan. Well, next year rates go up. The Fed raises rates, like they're talking about, and the next year's loan, you can lend somebody $1,000, and let's say it's Procter & Gamble, and they'll pay you 1.5% a year. Well, now you have this. Both companies aren't going out of business, and the person who lent $1,000 out to collect 0.5% a year, and there's somebody else out there with $1,000 loan paying you 1.5% a year, and you're the other person, you say, I can buy either one of these bonds. Are you going to pay $1,000 for both of those? Of course not. You're going to pay less for the one paying 0.5% a year. And that's what happens. That's what happens when inflation occurs. Bond values deflate. Now, you have the right, if you own the bond, to carry it to fruition and watch it mature in 10 years and collect your $1,000 back, but you got to wait 10 years for that. So what's that new 1% of income worth to you or to someone else? And so with these floating rate loans, yeah, they're loans, they're bonds of some sort, but they are floating. They're moving with the market, and that as interest rates go up, they go up. And they're a very strong tool if you know what you're doing.
You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We have been talking about inflation and investing through inflationary periods. There's so many great places that you can go. And there's definitely a lot of risk involved where people just may not feel comfortable with what's going on all around the world, or in the market or in the economy. And we get it. There's got to be some portion of you that's like, hey, hold on a minute, can I push the pause button? Well, what do you do? I mean, do you hold on to cash, which is going backwards at 7.8%? Because that's not going to work for you in an inflationary period. But we talk about hedges, and these are places where we can just kind of maybe incrementally buffer ourselves a little bit at a time, so it's not a full load of 7.8% negative. What are some of those things that you can do, Dan?
Well, we've run through a bunch of those, but I think more to consider are these different sectors that you just know people got to have. And I think next on the list was to take a look at healthcare, right? Coming on the heels of a pandemic, there's obviously been a lot of interest in that particular sector. But it is one of those places that no matter what's going on there in the world, people will continue to pursue healthcare. Those companies will continue to generate revenue. And in this space, with all that's gone on in the world, that they're on the receiving end of heavy investment dollars for research and development of different treatments and different protocols for how to deal specifically with a pandemic. So there's a lot of things going on in that sector that would point to, ongoing consistent returns. And I think that, again, being one of those can't live without it type of products that they have, that's a good place to turn to in an inflationary period.
I think healthcare is an interesting space because I think it has made its money over the short term. And in a traditional environment, yeah, I totally agree. I do think a long range, I think we see some value there. But I think I think my job here is to end with a number 8 here, which is high yield stocks and the value stocks in the blue chip world. We've chatted about that a little bit here and there, and there's a lot of plays inside the healthcare space that include that. And so I think that's an interesting combination piece. We have what we call the BFG portfolio with the large mid value holdings, which is really focused on driving value, driving yield, and creating opportunity around that. And I think between just the inflationary environment, I think you take, I mean, I don't think you invest in one thing because of one reason, right? So, I mean, that's why we always like label, hey, this is a couple of reasons why we do this. You know, inflation's going to drive, you know, value to be an opportunity. It's something people are looking for yield where they can't find it in bonds, and they're looking for safety. The second piece is that, you know, the massive growing number of people retiring, the astronomical number coming down the road, the demand for that blue chip safety kind of feeling stock, that Procter and Gamble, you know, the Chevron, the Exxon, whatever it is out there that you think is kind of that substance, that safe place for you in the stock world, everyone's going to be flocking in that direction for the same reasons that they're, you know, not flocking to bonds, because the rates aren't high enough and everyone wants income. So it's all about that. And as we finish up this show, we want to talk about the don't. The big number don't. Don't do cash. Cash is the worst thing you can do in an inflationary environment. Everything else we named is probably a better investment than cash. The U.S. dollar is deflating at a rapid pace, and God forbid that this Russia-Ukraine thing and everything else, and all of a sudden the U.S. dollar doesn't trade oil, the U.S. dollar just falls. I mean, I honestly think the U.S. dollar is probably one of the worst things to be feeling safe in. Out of all the things that you can own, I believe blue chip stocks are a better, you know, international currency than the U.S. dollar. I'm sure there's a lot of currency traders out there that might disagree with me, but I think that the U.S. dollar is something you convert to out of an asset to create income to buy the food you need to put on your table. That's how simplistic form of cash I think has value in the U.S. dollar. It's okay to disagree with me. I really think that it's not an inflationary asset, right? It's a very troubled inflationary asset right now. I think it has a lot of vulnerabilities on the global scale, but it is also the number one that we do oil in. It's also the number one currency that a lot of the black markets use internationally because it has the...
Yeah, you could trade a dollar anywhere. I mean, that's,
you can trade a dollar anywhere.
The beauty of it. But from an investment perspective, which is different from a practicality and, you know, paying the bills perspective in a lot of ways. But, you know, we're trying to help people capture assets that are likely to appreciate. And the dollar cash is just not one of those, not in an inflationary period.
Not at all. And we see so many people that feel really good about having the cash, and they might have 50 or 100 or $1 million in cash. And we meet people in all walks of life, and they feel really good about that. But the truth is that in 10 years, whether you have 50, 100,000 or $1 million in cash, it's not going to be worth nearly what it's worth today. And so you need that money to move forward with you and the market so that you can, you know, actually have a spendable asset of equivalent value or close to it in the future. I even was speaking to somebody the other day. I said, the cash in your account is so horrible. And they said, we're just not people that want to take any risk. And I said, go buy a fixed annuity paying 3%. They offer fixed annuities that pay 3%. It's like it might be half of what the inflation's doing, but you're mitigating, you're reducing the amount of loss you're having in this marketplace. There's always something you can do if you have cash. And if you are sitting in cash feeling the pressure of inflation and knowing it's weighing on you, you can call us. We can find equivalent kind of assets. There's other investment programs you can do, even in government-backed securities, that we can do for you to help mitigate some of that. They may not be the top 8 we're talking about now, but they can mitigate some of that loss.
Yeah, there's cash, bonds, consumer discretionary like travel, luxury retail, or collectibles. These are all places where we would say just, you know, it's not the time or the place. Not that it couldn't be fun to be in doing some of those things as well. But if you are in that cash position or one of these other positions, you really need to take a look at what's the purpose, right? That's what it's all about, is having some intentionality and some purpose and some design around what it is that you're doing, not just because you feel this way, okay? And that can lead you down a wrong path, especially when you need something like this to help you get to the next place you want to go. maximize the structure, maximize the opportunity, maximize your income down the road or right now in retirement. You're listening to Money on Tap. We've been talking about investing during inflationary periods, what you can do, what you shouldn't do. Give us a call at 855-226-8551 or info@yourmoneyontap.com. Looking forward to talking to you and putting that plan together for your next step. Have a great week.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.